doing well. So, surprise, surprise, another U.S. bank has just bit the dust. Yes, the doors of Citizens Bank have just been closed. And this is despite, of course, all the reassurances, the prognostications from the likes of Jerome Powell and Janet Yellen that the U.S. financial system is well capitalized, it's robust, it can withstand anything. Well, here you have it, folks. The 2023 financial crisis claims another victim. Yeah, Citizens Bank in Iowa has been closed. This is from the FDIC here. A failed bank information for Citizens Bank. And let's see, we'll get into some numbers here in just a moment regarding this bank, because this was not a huge bank, but I believe this is a sign of things that are to come. And of course, we've been mentioning on this channel that this crisis is far from over, still has a lot to go before all is said and done and before this officially plays out. I mean, when I see banks failing, of course, one of the things that it reminds me is that it's important to have hard assets outside of the financial system. And in my case, I like to do that with gold and silver. That's why I've been stacking it at an even faster pace ever since this financial crisis kicked off back in March. Now, if you want to stack some gold or silver, make sure you check out today's video sponsor, sdbullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Okay, so check them out. It helps to support the channel, to support our sponsors. But let's talk about Citizens Bank here. So this is yesterday, Friday, November 23rd. Citizens Bank was closed by the Iowa Division of Banking. The FDIC was named the receiver. No advance notice is given to the public when a financial institution is closed. So, if you woke up on Friday and you had deposit there, you probably thought everything was fine. Well, by the end of the day, your bank was closed. The full balance of all deposits have been transferred to Iowa Trust and Savings Bank. Now, basically, these depositors were bailed out by the FDIC. We've got some numbers here in a report from Siouxland Proud. I believe this is like a local news publication from this area. Citizens Bank, established in 1929, 65 million in total assets, 58 million in total deposits as of its third quarter call report. And this bailout cost the FDIC, let's see, I've got the number here in this other report from another local news institution. The transition incurs a $14.8 million cost to the Deposit Insurance Fund. Now, again, this is not a huge bank. The deposit fund has the funds to cover this, but there's a few things we can take away from this. The financial crisis is not over, and I think that, when you hear the chairman of the Federal Reserve, Jerome Powell, and the Secretary of the Treasury, Janet Yellen, telling us that the U.S. financial system is well capitalized and robust, you've got to understand that that's just a line of BS. I mean, they can't say anything else because it's all a confidence game, but clearly the financial system is still experiencing some very significant problems, as we just had another bank close. Now, let's talk about why this is occurring and why the big banks, the too big to fail ones, are also likely experiencing some significant problems on their balance sheet. Now, here's an article from Business Insider from Friday, yesterday. Defaults of high-yield corporate bonds are accelerating and could bring a $46 billion wave of distressed debt in 2024. That's from Bank of America. Hey, Constitutional Stacker, thanks for that super chat. No, I'm not lighting a cigarette, folks. I am a little under the weather now, so if I cough or you catch me gargling on my own secretions, I apologize. But, even if you're feeling a little under the weather, you still got to get this information out there. At least that's the way I look at it. Yeah, so Bank of America warning that the U.S. could see a $46 billion wave of distressed high-yield debt next year because defaults are accelerating and could speed up at 1.5 times the pace next year. higher interest rates could cause defaults and bankruptcies to peak in early 2024. Experts warn. So that is right around the corner. And, this is just another one of these stressors on these banks. We're going to get into the real big ones in just a moment. But high yield debt is beginning to get defaulted on. This is from industries like the health sector, the cable sector, technology, media, and telecom. Those sectors account for $35 billion, just those three sectors alone. And so, businesses are coming under pressure because of rising rates and the massive amount of debt out there. And we've mentioned several times on this channel that it's impossible to tell what's going to fail in this economy. There's just a huge amount of leverage out there. Inflation is remaining stubbornly high as interest rates continue to rise, both from the Federal Reserve tightening conditions, but also because of rising inflation. Many of these players, whether it be individuals, whether it be businesses, corporations, governments, they're all beginning to see the cracks show. And this is just another example. And, I don't think that we've really seen anything yet. They mention here that these high yield defaults are looking to peak in 2024 and bankruptcies are going to peak. Well, that means that, if we're getting banks failing now in November, imagine what's going to be happening by January or February. And, this is not to mention all of the other things going on in the world. This is just domestically, the financial system on the path that we're on is, extremely fragile and very susceptible to crises. Here's another one now this is an old one. This is from Fortune, but this is an important one to revisit. This is from right around when this whole financial crisis of 2023 kicked off. From Fortune, U.S. banks are sitting on $1.7 trillion in unrealized losses, research says. That's not a problem until it is. Well, I guess it's a problem for Citizens Bank now because they just failed. And, many of these banks are sitting on these unrealized losses as a result of rising interest rates, rising yields on the treasuries. And as the rates on U.S. treasuries rises, the losses mount higher and higher from these banks. Now, they use a lot of accounting tactics to try to disguise these losses. These are all unrealized losses. So the banks are sitting on these piles of, devaluing assets, but they have a face value. They have a nominal value. They're bonds. So the banks basically just tell us, well, we'll just sit on them until maturity and we won't take any losses. But the problem comes when banks see things like, other assets failing because they're being defaulted on, for example, or deposits being withdrawn by customers who are losing faith in the banks. Then they have to sell these assets to raise funds. And that's exactly what we saw happen in March, which caused the banks to begin to fail with SVB and the rest of that gang. But this problem has not gone away. Of course, rates continue to rise. And here's one from earlier in October about how JP Morgan, the largest bank, bond losses hit $40 billion. Now, this was from October 13th. They point out rightly that Bank of America's should be even more. And Bank of America is a very unhealthy bank at the moment. Here's one from Reuters when we had Bank of America report their losses on October 17th. Bank of America's unrealized losses on securities rose to $131.6 billion. Thank you, Joe. Yeah, the Scottsdale 20-ounce bars are beautiful. Thanks for that super chat. Appreciate that. And I hope you're feeling better, Constitutional Stacker. So, Bank of America has the largest unrealized losses of all these major banks. According to them, the losses have grown from the second quarter, but the bank does not expect the portfolio will generate actual losses in the long term. Of course they don't. Yeah, they won't have to sell any of those. They won't have to realize any of those losses. Let me know in the chat what you think about these $131 billion of losses at Bank of America. Do you think that there's a possibility that they might need to realize those losses? Do you think there's a possibility that depositors might look at this and think, maybe we should put our money somewhere else? Give me a 1 in the chat if you think that it's possible they may have to realize these losses. I would like to know what you have to think, because I think that that is a real possibility. But again, this is all a confidence game. So, of course, they have to tell us, oh, this will be fine. We're not going to actually have to lose anything. It's just, on on our balance sheet. That's where we have $131 billion in losses. Analysts say it is highly unlikely that Bank of America would sell the securities at a loss because the lender has strong liquidity with consumer deposits and higher capital. Well, for now, I suppose. They got to paint a pretty picture here for us, folks, because if they don't, if confidence is lost in this financial system, well, we've already got banks failing yesterday, got another bank failing yesterday. So just imagine what could be in store for us. All these unrealized losses are on government guaranteed securities. Because we're holding them to maturity, we will anticipate that we will have zero losses over time. Bank of America's chief financial officer, Alistair Borthwick, told reporters. So I guess it doesn't matter to Bank of America how high rates go, and they are likely to go much higher, if you ask me, as a result of massive amounts of deficit spending, meaning more treasuries will be sold onto the market, combined with rising inflation. And here's a good indication that depositors may not decide to keep their deposits with these banks. So this one's from Reuters from Thursday, November 2nd, just a couple days ago. It's an exclusive report. Swiss authorities and banks mold new rules to prevent bank runs. Why do you think they might be mulling those plans? And here's some of the measures that these banks are considering to prevent bank runs. Now, mind you, this is in the wake of Credit Suisse's failure earlier this year. They had to be rescued, bailed out, basically. But, all these problems, they just keep getting papered over. So here are some of the measures to discourage depositors from withdrawing their funds. And this is another reason that, listen, I mean, I don't give financial advice, but if you've got a lot of money concentrated in some of these too big to fail banks or any banks, you might consider, pulling it out, maybe putting it in credit union, maybe keeping some cash on hand. But the problem with that is, listen, these banks fail. The FDIC, they have the money to bail out $14 million or whatever it was for Citizens Bank. They don't have billions or trillions of dollars to bail out JP Morgan, Bank of America, and Wells Fargo. So if those banks get a bailout, even if you pull your cash out and you have it outside of the bank, it's going to be devalued by inflation. Because any bailout that these banks are going to get, it's not going to come from the FDIC. It's going to have to come in the form of printed currency from the Federal Reserve. Thank you, Chef Stacker. I appreciate the super chat. Always appreciate everybody who supports this channel. And hey, listen, always like super chats. If anybody wants to give me a super chat, that's fantastic. But if you don't, if you do find this information valuable, please at least smash the like button. Right now we're at 88 thumbs up, 330 people watching, and if we could get to, 150 people liking the video, I think that this information is important enough to help spread it. Because listen, if you've got money in a bank, you need to pay attention to this. Even if you get bailed out, even if depositors are made whole, the money is not going to have any purchasing power, okay? It's not possible to bail everybody out and have the purchasing power of the currency maintained. Thank you, Tiger Stacker. Appreciate that. Okay, now back to this. This is important. These measures that the banks may implement to try to discourage depositors from withdrawing. One is to stagger a greater portion of withdrawals over longer periods of time. So I think you can interpret that as them imposing limits on what can be withdrawn within a time frame. So if you've got $1 million in the bank, maybe you can only pull out $10,000 at a time. I believe that this is something that we've witnessed in places like Cyprus, where they limited withdrawals, limited ATM transactions. You don't want to wait until these things go into effect to try to get your money out of the bank. Of course, I've got money in the bank. You've got to use the banking system to some extent, but it's very important, I think, to diversify. And, getting some gold and silver in your possession, real money, the stuff that's been money for thousands of years, this can't get printed. So even if the too big to fail banks, they have to print up billions or trillions of dollars worth of currency to bail out the depositors, they can't steal the purchasing power from your silver. So that's why I like to have some of that on hand. Let me know what you think in the chat or in the comments if you agree. Some other things they would do is they're considering rewarding clients who tie up their savings for longer with higher interest rates. So, they say, well, listen, if you don't pull your cash out, we'll reward you with a higher interest rate. But, I mean, given the fact that banks are failing and that inflation is almost guaranteed to continue running out of control, who wants to commit their wealth to a long period of time, even if it is for a higher interest rate that's just being paid in devaluing fiat currency? This is a scary one. They're considering imposing fees on exits. So, yeah, you can withdraw your money, but you got to pay us to do it. So, I mean, essentially, when you impose a fee on a withdrawal, that's sort of like a bail-in of a percentage of someone's deposits, right? So you got $100,000 in the bank, you want to pull it out, they say, well, you got to give us 5%. So, how much do you really have in the bank? It's really more like $95,000 if you think about it, because if you want to actually access those funds, pull them out, well, there you go. They're going to take part of it from you. So, why would they be considering this, I wonder, when, as we're told by the powers that be, by the chair of the Federal Reserve, by the Secretary of the Treasury, that everything is fine, that they're, well capitalized, there's nothing to worry about. Why are they worried about plans to avert bank runs, I ask you? I think that is a very good question to ask yourself. And, you've got to read between the lines here, folks. You can't just accept what we're being told at face value. I see a few people in the chat probably joining the live stream wondering what bank failed. Well, it was Citizens Bank in Iowa. The FDIC closed their doors and their depositors were made whole to the tune of more than $10 million, and their deposits were taken over by other banks. So, the financial crisis is not over. And if you want further indication of that, let me just pull this chart up for you. This is the Bank Term Funding Program. This is the emergency lending facility that was established back in March to help these banks. Basically, what the Fed said is, those bonds are not worth very much, but they still have a high face value. So what we'll do is we will take those devalued bonds, we'll put them on our balance sheet at their face value, and we'll use them as collateral for loans to these distressed banks. So this was set up back in March. You can see that it's been moving up ever since. It actually just hit a new record. The most recent data from November 1st shows that now the amount of loans being issued by the Bank Term Funding Program, $109 billion. So do you think that those banks are going to take those devalued bonds back and pay back these loans? Put a 2 in the chat if you think that they'll pay back the loans and the Fed will return these devalued bonds to them. Put a 3 if you think that this is probably just quantitative easing by another name, and that these banks, I mean, it doesn't make any sense. Why would the banks ever repay these loans? What do they get back? They get back a bunch of devalued toxic assets if they do that. So to me, I mean, the Fed is likely just going to keep these devalued bonds on their balance sheet. This is basically just QE by another name. Jerome Powell was actually asked about this at the recent FOMC press conference, and he basically just said he wasn't worried about it. He said, well, it's a year-long program. It seemed to be what he was telling us. So I guess this is set up for, 1 year, and that they'll review it in March. But he's not concerned that it's at a record high. I mean, I don't know what the exit strategy for this is, but I anticipate that we're going to see this number continue to move higher. And then very likely in March, I mean, if the whole financial system hasn't collapsed by then, which is kind of a big if at this point, if you ask me, we're probably just going to see this program extended, perhaps expanded, if this is still a problem. And I think it will be, because rates are likely to continue moving higher. Let's talk about rates real quick. So we saw a bit of a pullback actually in rates. Someone was getting into the market and buying up U.S. debt, and you'd think that this would help out some of these banks, but I mean, I guess it was too late for Citizens Bank. And Citizens Bank also, there were reports that they had some loans that they didn't know were bad, In fact, I think before we talk about rates, let's go back to one of those articles because this was interesting, and I kind of glanced over this when we first started this live stream. Um, but it says a press release from the FDIC. Bank examiners identified significant loan losses that had not been previously identified by the bank while conducting an examination of the bank. Officials said Citizens Bank had a concentration of out of territory and out of state loans to one industry and then suffered heavy losses from some of those loans. The bank has since been declared insolvent. So remember, we've got reports that defaults of high yield corporate bonds are accelerating and are moving faster. I mean, just defaults on loan instruments across the board are going to be moving higher as the economy continues to weaken. And then, how many other banks out there do you think maybe have bad loans on their books that they just, whoops, haven't identified them yet? This goes to show that, at any time you can see more banks failing. And this is not going to be the last one to fail. Maybe it'll be the last one to fail in 2023. I don't know. I mean, we only got 2 months left, but things are not looking good. And despite the fact that the 10-year yield has eased off a little bit, we've seen someone coming into the market and buying up U.S. debt. It's still at the highest level since 2007, right before the Great Recession began. So it's not like, 4.55% is a significant relief to these banks. In fact, those reports that we had of Bank of America and JP Morgan seeing higher unrealized losses, those are all for Q3. So that was all when rates were actually lower than they are now. That was the end of September that would have ended. So where were rates back at the end of September? Well, if I can get Yahoo Charts to cooperate with me here, we can look that up. But you can see it was just slightly above where they're at now. At the end of Q3, we were at 4.57. So we're basically right there. So, as these rates continue to move up, and again, I think they're going to, I think this is just a bit of a head fake. This is because, well, what was it that triggered this? This was because investors are believing now that the Fed is close to a pause because of that terrible jobs report that we got on Friday. But, bad news is good news. That's the idea. And, maybe the Fed will pause right now. Of course, they paused back in 2006, too. If you look at a chart of the federal funds rate, you can see that they paused hiking in 2006. It wasn't enough to avert the financial crisis of 2007, 2008. So unless the Fed comes into the market now in force and begins printing large amounts of currency and buying up U.S. debt, these banks are just ticking time bombs. And of course, if the Fed does that, well, you're going to want to have some of this because inflation is going to absolutely run out of control. The bottom's going to fall out of the U.S. dollar, and depositors might all not have to worry about bank failures, but they're going to have to worry about massive devaluation of their holdings. Finally, this is something we talked about yesterday, but I think it's even more important in light of the fact that we just had another bank failure and the banks are coming under all this increased stress. Customers at major U.S. banks hit with deposit delays. So this was Bank of America, Wells Fargo, Chase. Several banks hit with deposit problems yesterday where depositors weren't seeing their direct deposits go through. Now, I don't know if this is just a glitch, if this is maybe a cyber attack. Excuse me. I mean, that's kind of where my mind goes, that this could potentially be a cyber attack. But it's just a reminder of how little faith we can have in this financial system. I think that this very likely could be a cyber attack, and that may not be the case. Again, nobody knows for sure. That's just my speculation. It just seems odd to me that all of a sudden, as the world is devolving into World War III, that we see major banks reporting that, oh, sorry, your deposits aren't showing up. Everything's fine. They issued a statement saying depositors didn't need to worry. I wonder if depositors at Citizens Bank needed to worry. I mean, they got bailed out by the FDIC, so I guess not technically, unless, of course, you had more than $250,000 deposited in Citizens Bank, in which case you probably had a lot to worry about because the FDIC only covers up to that amount. So, look, if you've got money in these banks, again, it's not financial advice. I'm not telling you what to do, but I would be highly circumspect about concentrating large portions of your wealth in these financial institutions, which clearly are not doing great. It's just a time to diversify. It is a time to be aware of the problems that we are facing. And I think that while I don't give advice, if you don't have any hard assets without counterparty risk outside of the financial system, you might want to reconsider that position pronto, because this is not going to be the last bank to fail, folks. Citizens Bank is just another canary in the coal mine. Already, the total deposits of all the banks that have failed in 2023 exceed the deposits of the banks that have failed in 2008. So, they're trying to basically run a psyop on us, it seems like, to just convince us that everything is fine, but obviously it's not. I mean, how can you say that the U.S. financial system, the U.S. banks are well capitalized and strong when you literally just had another one fail? There's a lot of problems in this system. The cracks are starting to show. The unrealized losses are in the trillions of dollars, folks. The FDIC doesn't have that much money. They're going to print it up when the, shizzy really hits the fizzy here. It's not looking good. So let me know what you think in the comments down below about this most recent bank failure. Do you think that more may be around the corner? I would love to hear what you have to say. Stay safe and happy stacking, everybody. I will catch you next time. Smart Silver Stacker, out.